Richard Moffat, the CEO of Urban Logistics, to talk through the recent results. They posted very good results, very well received results on the 12th of November. But to put a little bit of context, we think that the real estate sector has within it a number of opportunities that provide great security of income, but a limited number that provide that security with growth as well. Some of the more secure income REITs act a little bit like bond proxies. They collect assets with long-term leases and accrue the income. Urban Logistics, I think it was Richard that coined the phrase, is not a stamp collector. It just doesn't sit on these assets and wait for the rent to come in. It's quite actively managed, but it's a very strong sector, Urban Logistics. So I think if we start off, Richard, if I may, asking you about how you've put your portfolio together, and you do seem to buy very well in that the yields that you acquire at are above the comparable market and they're above the valuations that the assets sit on at the moment. So why do you think you've been able to put together this portfolio bought so well?
Well, thank you, Mike. I think the first thing to say is myself and the management team have been steeped in the world of logistics for now, unfortunately, about 30 years. And I think the important thing to remember is that our world is essentially differentiated as follows now. You have the big box assets, which are 300,000 square feet and above. You then got the urban logistics buildings, which are there, in our case, to send product to their ultimate destination, whether it be your home or your business. And they are distinctly logistics assets, as distinct from what we all know as the old multi-let industrial estates, which have a myriad of different consumers, whether it be manufacturers, trade counter operators like Travis Perkins or Speedy Hire or whatever. And really, so in other words, quasi retail right up to manufacturing. And those assets typically have a number of shortfalls as far as we're concerned. When we sat down to prescribe our investment thesis, our investment strategy, we decided that we didn't particularly like the amount of buildings that were available in the UK at those smaller size ranges. So you tend not to get the same strength of tenant covenant. The tenant will invariably have a lot more choice, and therefore can relocate quite easily. And also the cost of relocation is relatively modest. If you focus on the urban logistics side of life, and indeed big box, these occupiers, it is very expensive for these occupiers to relocate. And I remember seeing a piece of work many years ago undertaken by the Chartered Institute of Logistics and Transport, where they estimated it cost about £4 million to relocate a 100,000 square foot operation. So they don't take decisions to move lightly. Our WALT is only 5 years. Our weighted average unexpired lease term is only 5 years, but actually our buildings have been occupied for an excess of 20 years by our tenants. So that's an important distinction. So when we sat down and devised our strategy back in 2016, 15, 16, it was really to look at what had gone well in the past and what hadn't. And one of the things we wanted to eschew was the volatility of fashion retail and indeed automotive to a certain degree. So we decided that we would focus very much on UK staple goods. So in terms of our strategy, it's around UK staple goods in warehouses where product is going to be dispatched to its final destination. So intuitively, these are products that we need all of the time, whether it be food or pharmaceuticals or whatever. When it came to actually how we're going to construct the portfolio, we looked at the size of the market. And the size of the market back in 2015 was around 4 billion sterling deployed into assets of 20 to 200,000 square feet at that time. In other words, our size range. We figured that if we were going to build a sustainable business, it was cautiously sensible to think of creating a portfolio with a market cap of around 500 million by year 5. So in other words, acquiring somewhere in the region of 150 to 200 million of assets on an annual basis, with probably about 5% being recycled per annum on the way through. As we sit here today, just shy of 5 years, we're only at about 375 million market cap, but we have, of course, had the added complications of dealing with the Brexit votes and general elections and goodness knows what. So we have had some headwinds in terms of raising the equity to fulfill our ambition, but nevertheless, the performance has been there for all to see. And I think the reality is, with 100% rent collection for the last 3 quarters in probably the most stringent test that real estate has seen for many a year, I think probably tells its own story.
Thanks. You've talked about the recycling of capital, and I'll come back to that. But basically, the IPO was in April 2016, I think. So you've had quite a track record now in the public arena, and the asset returns have averaged about sort of 14-15% a year per annum over that time span. And I think one of the important things that we want to get across is that income is the real driver to the business. You do this to secure income, to get the rents and the rising rents from tenants. But perhaps slightly unusually, there's quite a big capital increase as well. And investors might not knowing you so well might see that this is a sector which clearly is attractive, values are rising. But I noted something you said earlier when we were speaking before, that about 80% of the capital return, the capital uplift within that 14-15% a year return that you're making overall, about 80% of the capital uplift is asset management. So it's not just sitting on the market and seeing it going up. The asset management is re-gearing leases, doing very modest but targeted refurbishment. And on the recycling of capital, that means that you're selling some of these assets that you bought earlier, and you're selling them at prices that seem to indicate that value that you add on paper is value you've added in fact, because you've been able to crystallize that uplift. So can you just confirm, was I right to pick up that about 3/4 or 80% of the capital uplift is asset management, and what that means?
Yeah, I think our total property return since IPO has been at 15% per annum. Our total accounting return has been at 13.2% per annum. And our average EPRA NAV per share growth has been at 8.2%, just to be clear. But I think as far as the recycling of capital is concerned, we've disposed of assets at an average exit yield of 5.8% against an average purchase yield of 6.5%. And that's been at an 8% average premium to book value, or an average, sorry, it's been 8% against as an average premium on the disposal to book value since IPO, which has engendered 49% total property returns from assets sold since IPO. So I think it's important that we all remember the Brixton scenario. I think it's really important that we continue to prove to our investors and indeed to ourselves that our values are right. That said, clearly valuers have to be backward looking, and it's evidentially based. So our job is to try and, to a certain extent, determine where the market will be and where the market will go, and make sure that we're ahead of that.
And you said that your average yield on acquisition is net initial yield is 6.5%, and the most recent assets have been bought nearly at that level. I mean, it's sort of well over 6% that the significant assets that you bought this year have been at. So you're still securing them on those good yields, even though there's a strong bias towards the southeast, which obviously is the hottest market in all. I think 2/3 of your assets are in the southeast, aren't they? So is there a particular desire to just do the southeast, or do you see the UK as a whole as being your stomping ground?
I think at the end of the day, what we've always said is we want to buy buildings which to our occupiers are mission critical, wherever they are so located. I think we are very focused on the functionality of buildings, and we're very focused on what happens within our buildings. So put simply, we want to know the building is mission critical to the occupier. Within that, we also know that certain geographies are more constrained than others. And to take the southeast as an example, 35% of all industrial land in the southeast has been lost in the last 10 years to high value uses. We've also seen land values rise at unprecedented levels for development land for logistics. And if you look at this year, for example, I think the range of land values that have been crystallised in the southeast range from about 5 million an acre to £7.5 an acre. What that means is, because we develop at 20,000 square feet to the acre, if we accept that the average land value is £6 million an acre, that means that the capital value per square foot of the land in a development appraisal is £300. It will, generally speaking, cost between £60 and £70 per square foot to build that building. So if we're talking about, after we've added in fees and stamp duty and everything else, if we assume that replacement cost today of buildings in the southeast is somewhere in the order of £350 to £400 per square foot, then clearly if we're acquiring buildings at £150 to £200 a square foot, we're at a significant discount. Now, what that means is that we will, or we should, always be able to offer our buildings at a discount to new stock. And in certain geographies, we are building new stock, but where we can see land is cheaper than the wider market. So the short answer is, as I sit here today, 29.5% of our portfolio is located in the southeast. Why? Because it's got the highest rental growth conviction, in our opinion. And that's fundamentally down to the supply-demand imbalance. That said, we are focused around all the urban areas, or significant urban areas in the UK, from Aberdeen to Edinburgh, Glasgow, Newcastle, Leeds, Manchester, and heading all the way south through Leicester, Nottingham, Milton Keynes, and so on. So we will always have buildings where there is a strong urban focus, and where there is available labour, because labour is so important to logistics occupiers today. So we are focused on the southeast, but equally we're very focused on other geographies with good motorway access and so on.
You mentioned the labour, which is quite very interesting, because these buildings, they're mission critical. They might be distributing pharmaceuticals or things like that, but there's people that work in them. And so I think that it's quite interesting and important that at the results presentation you highlighted that about 73%, I think, of the portfolio is A to C EPC rated. And okay, that's an EPC rating, but I think it gives an impression that these are quite modern buildings. They're not new build, but they are modern assets that are going to be a key part, I guess, of your tenants' ability to recruit and keep labour. And you said about how many years the tenants tend to stay in these assets. So I guess the configuration of the assets is important to the labour force, isn't it?
Yeah, I think it's fair to say that we all get fixated about rent, but rent is really only 10 to 12% of the occupier's overhead, and labour is typically 35 to 45%. So you're absolutely right. Labour is very, very important, and it's equally, working conditions are very, very important. So it is really important to us that our buildings are fit for purpose. And not to get too fixated about shiny tin roofs, because at the end of the day, we know we can recover a building for between £10 and £15 per square foot. as long as the structural integrity of the steel frame and the concrete yards and so on are sound, then actually we can improve the appearance in pretty short order and at low cost.
So,
but what we can't do is tolerate things like asbestos or any of those nasties that were in the old manufacturing buildings of yesteryear. Just to be clear, ours are, by and large, modern buildings built in the last 30 years, 2x1 in shape, with all the characteristics that you would expect in a modern warehouse. And the EPC ratings are an important benchmark within that. By 2025, we have to have 100% of our buildings, by statute, have to be within the A to C category. And currently we are, we're about 73%, I think, which I think places us in ranking terms somewhere just behind Tritax and just in front of Segro at the last count.
And you've got green leases and so forth. I was also looking at the configuration, because I think it's important to look at photos. Unfortunately, it's difficult to go out and visit sites just these past few months, but the photographs show a reasonable site cover, but it's not, these aren't cramped sites. You're not going out to make big new developments on greenfield sites, but have you been doing a little bit of infill, which would only be extra value added, cream on the cake?
Yes, I think it's it's part of our ESG review. We've noted the fact that by and large we are refurbishing existing buildings rather than taking land out of Greenbelt. And where we are building new facilities, they are typically on infill sites, brownfield sites, which wouldn't really be much use for anything else. Mm-hmm. So I think that's important. Sometimes we buy buildings where there is a parcel of land adjacent or whatever, which can be built on, which clearly is a value add, which we look at quite carefully. But we're also looking at any value enhancement opportunities across our portfolio.
So I think the rent, as you say, is a really absolutely crucial part of the matrix. You actually make very good returns on the capital side of things. We talked about the value add, and also that this is a market which is rising in value. But on the rents, I think it's really important that I believe the average rent is £4.90 per square foot. And some of these sort of shiny new sheds in the southeast would be kind of £10 plus per square foot. So there's clearly, it's not going to get to that level, but there is an upward movement in the rents. The valuers are saying there's a reversionary potential. And I'm just wondering, your average rent increase on the reviews that you've done since flotation have been 24%. Clearly that's not per annum. I mean, it's every sort of 4 or 5 years when there's a review. But what sort of feedback or pushback do you get from your tenants when you ask them for this sort of average rent increase on the rental reviews of 24%? Are they reasonable in terms of agreeing that, or is there negotiation? Do they ask you to improve the buildings? Do they ask you for rent freeze? A little bit more colour.
Yeah, look, I think what we try and engender is a partnership approach from the off. We want to build long-term sustainable relationships with our tenants. And as part of that, when we visit site for the first time, we want to understand how efficient that building is for their operation. I talked earlier about buildings being mission critical, but actually beyond that, how could the building be made more efficient from their perspective? And of course, with ESG so high on certainly large corporate agendas, then what can we do in terms of low energy lighting, car charging points, whatever it happens to be. So we look at ways that we can invest further into our building, in return for which we'll restructure a lease, maybe make it longer, and also settle a rent review. So everybody gets fixated about rent, but it really isn't the biggest thing in all of this. It usually gets captured in a wider ranging discussion. And I think we've settled over 85% of our rent reviews since IPO have been settled well over 6 months in advance of the due date. And that's really down to the fact that we've usually found something else that we need to try and document over and above the rent reviews. So quite often we'll be perfectly happy to extend a lease term and take a slightly lower rent. And of course, it's a blend, but it's working with the occupier to give them what they need and what they want.
If we can just sort of touch very briefly on the results, because I think the more important point that I'm trying to get a grip on and help put across is that, you know, the management has got a very good relationship with the tenants. The tenants are paying rent increases, the capital value is going up, but clearly the latest results are the trigger for this little video. So your total accounting return, I think for the 6 months only was 5.5%, which actually had a lot of headwinds. The headwinds weren't particularly COVID related. You came out of that flying colours, you know, 97% of the rent paid on time, the rest coming very shortly afterwards. But there were headwinds from the deployment of capital, which obviously costs a lot of money, and you've more than doubled the size of the business by new equity raise. So can you just sort of highlight, although the EPS rather per share fell because of the significant increased number of shares, that doesn't really reflect the underlying level of the business. The level of the results in the first half was quite a pleasant surprise to the market, I think.
Yeah, look, I think the like-for-like valuation uplift was 5% as against a year earlier at 3.8%. I think we have seen further yield compression since the end of the reporting period, and I think we'll see some significant valuation uplift in the second half. As far as the accounting return at 5.5% is concerned, that compares with 8.2% in the year previously. And as you rightly point out, we have absorbed a lot of acquisition costs in relation to the assets themselves, and indeed the costs, obviously, of retaining. Yeah, exactly. The total shareholder return, however, at 21.8% is pretty positive, and I think, you know, over 17%, no, not over, but 17% of our contracted rents were due for review within 6 months of the period end. Now, what I can tell you is, as I sit here now, we are incredibly busy doing a lot of that negotiation that we probably would like to have done a year earlier. But the reality is, a year earlier saw us in the teeth of the Brexit uncertainty. Forget about COVID for a minute. This is about occupiers trying to fathom what a post-Brexit Britain is going to look like for them. Yeah. And that's really more about the macro level than the micro level. So we had tenants with whom we have very strong relationships, who we've known for 25 years or whatever, saying to us, look, can we just put those discussions on hold for now? We're perfectly happy in your building, but what we need to be doing is to understand what customs clearance is going to look like, what trade tariffs might be in place, and so on and so forth. Not that they knew specifically, but actually to plan for it. So it would be ignorant of us not to work with them. That said, we're now in a position where I think the effect of COVID is also helping, in so much as we were all fed up of reading about the growth in e-commerce and all of that. But the other thing that we saw was all the panic buying resulting in shortages of stock. And, you know, as I say, all of my working life, the holy grail has been to same-day delivery. We found that global supply chains were deficient. There wasn't sufficient buffer. And as a consequence, what we're seeing on the ground day to day is a situation where occupiers are very keen to secure their long-term future. So whilst last year we didn't do anything like as much asset management as we would have liked, you will see over the back half of this year and into next year a huge amount of asset management, which really plays into all of those things that I've been talking about.
And obviously you're in the middle of a substantial expansion phase, buying at really good yields north of 6%. And sort of how do you do it? So it's interesting to look at some of the detail, but we haven't got the time to go into too much detail. But some of the larger acquisitions that you've done, have been of portfolios. I think one was called the Paloma and the other one is Crown. And I was interested as to what you were saying about why the vendors were looking to deal. And indeed, they, I believe, would have been very keen to deal with you because you're known to see through to completion. So if you could just in a one-liner on those two portfolios, give a little bit of background as to why they were looking to sell.
I think in the case of the Crown portfolio, it was an institution selling, and it was the rump end of a multi-asset portfolio where they needed a very secure exit, and we'd like to think we provided that for them. So there was a benefit to both sides in affecting the trade. The Paloma portfolio was simply a collection of single-let assets within a multi-let strategy, where the vendor wanted to conclude a sale as the vehicle was getting to the end of life stage. In both cases, we'd known both vendors very, very well for a long period of time. And I think, again, it plays to our strengths of always trying to do what we say we're going to do in terms of acquisitions.
Yeah. So the current half year that you're in, I guess we're going to be very likely seeing more of these acquisitions. I mean, you've illustrated some of the ones in the past, but you've had 2 fundraisers, and I believe that the message is that they will be fully invested and geared up with a little bit of debt by very early calendar next year. But clearly you're buying very carefully and using your connections built up over maybe too many years, but for investors, it's the ideal period. So that'll be fully invested. And then you referred to, I think it's 17% of the portfolio, the leases are coming up for regearing, and obviously the market is moving in your favor. So there's very, very likely to be quite a lot of built-in income rise from that. And then the full year that follows on to March 22 will be, you know, in a fully invested rent increase situation. So by that time, I think that the market is estimating that you'll have fully covered dividends, with the dividends higher than they are now. So we're in a good growth situation with very interesting management, interesting to speak with. Thanks very much indeed. I don't know if there's anything I've missed. I'm sure there is, but thank you very much for your time, Richard. Have you got anything else that you'd like to sort of add about where you want this business to be, perhaps in a year's time?
Well, thank you very much, Mike. No, I think we're comfortable with where we're at. We're seeing significant opportunity to continue to invest. But as we've done for the last 12 months in a very difficult period, I think we've shown a high degree of caution in terms of how we've deployed the equity, making sure that we've collected all of our rents before we push the button on further acquisitions. And I think, you know, we're very comfortable having 87% of our tenant covenants in the low or low moderate risk category, which obviously has told its own tale through the lockdown period. So yeah, I agree with you. I think our dividends should be on the rise from the next reporting period onwards.
Great. I look forward to helping us through all these pharmaceuticals that need to be distributed and getting us through Brexit. So it's not all down to you, but you're going to be quite a key part of it. Thanks very much, Richard. No pressure. Bye-bye.
Thank you, Mike.